Hello, Trinity Tigers, and welcome to Tiger Enrichment Lifelong Learning, a webinar series for Trinity University alumni. My name is Paige Fields, and I'm the Dean of the School of Business. Hopefully, you've received a worksheet from the Alumni Relations Office emailed to you last week, and if you have a copy in front of you, that will help you follow along with today's discussion. Please feel free to submit questions at any time during the presentation. It is my pleasure to introduce to you John Abeyta, and he is class of '98. He's Vice President of Morgan Stanley Wealth Management. John has spent over 18 years in the finance industry, and today he is going to be discussing financial wellness, goal setting, cash flow, and budgeting. John?
Thank you, Paige. How are you doing out there? Thanks for joining us today. I'm really excited about doing this because in 1998, when I graduated from Trinity, I was a finance major and studied business and dealt with this stuff all my college career, but I didn't get into the real world, and I didn't necessarily know some of the basic finance 101s. And so I always thought back that, we enter Trinity and they make us take the writing workshop, and they say, basically, you don't know how to write yet. We need to teach you to write. Well, one thing that we don't learn is how do we take care of some of our personal financial wellness and just basic financial habits of daily living. So I'm really excited to bring this to the Trinity alumni and some of the student body, and I hope you get a lot out of it. So with that, let's start our presentation. Okay, so this is a series of multiple modules, and this is just module 1, goal setting, cash flow, and budgeting. By the end of today, our objective is that you're going to define and prioritize your financial goals. You're going to be able to understand your resources. This is going to be what you own and a statement of your net worth, and then also what's going on a monthly basis from a cash flow analysis standpoint. We also want you to be able to determine where you can come back on spending if you need to, and that'll help you create a budget. By recognizing these actions, you can actually start taking active roles in improving your financial situation. And remember, it's not something that happens overnight. It's something that we do over step-by-step things and building good foundations and habits early on. So let's talk about the bigger picture and why this is even an issue. If you look at the workforce in America today, and this is a study of employees in the workplace, 39% of them say they spend more than 3 hours a week dealing with issues related to their personal finances. Okay, so this is a big distraction. So as we're entering the workforce or we're in the workforce, we have to identify that Americans as a whole are spending a lot of time dealing with personal issues rather than their work. That can be an issue. 36% of employees find it difficult to meet household expenses. This means that we're living paycheck to paycheck. That's not uncommon. And then about half of us say that it's very stressful to deal with financial issues. So if you're one of these people that says, ooh, money, finance, that's scary, you're not alone. That's about half of us out there. So the good thing is doing little exercises like what we're doing today will help empower you to take advantage of that. Maybe not take away all the stress, but eliminate it somewhat. So I need you to ask yourself, what are my financial goals? We don't really do that very often. So if you don't do that, you may not be able to ask yourself, what does my cash flow look like? Where do I need to cut back if I even need to? What changes can I make on my daily basis to meet my financial needs and goals? And then what is my net worth? What do I own? What do I owe? Where do I stand? I'd like y'all to flip to page 3 in the workbook. And this is a great little book that you can follow along. It's actually doesn't follow the presentation exactly, but you can use it after the fact, and it's a nice planning tool. So I'd encourage you to save this so you can use it in future years. But start asking yourself some of these questions on page 3. Have I made a list of my financial goals? Have I prepared a net worth statement in the last year? Have I prepared cash flow summary in the last year? If you're answering no to a couple of these, I think this exercise and this information is going to be very helpful to you. And I'd encourage you to review this on an ongoing basis, because we're not going to say anything dramatically new to you here. It's going to be all the things you already kind of know or you might be able to guess right at, but it's the act of doing them that helps make us financially healthy. So when we're going through life, a lot of times it just happens to us. So it's really important to be proactive and aware of what's going on versus letting things happen to you. And so on a daily basis, we're making financial trade-offs that are going to reach into the future and will create uncertainty. So one example is buying a vehicle. If you buy a car and it's $40,000 today, and you could have bought a very similar model, but maybe a 1-year-old version of it, it might have only cost $30,000. Well, it may not seem different when you're buying it because it's financed, and we'll talk about that a little bit later. But that's $10,000 you can have committed that you cannot spend somewhere else, like retirement, a vacation, a child's education fund. So it's really important when you're making these transactions and decisions that you're being mindful of that. The other thing that we see is a real issue. Excuse me there while I sip some water. Is actually discussing these trade-offs with family members. You know, a lot of us have a partner or a family member that's involved in the day-to-day finances, and it's really important to understand what their goals are too, because you might find that you have competing goals or goals that aren't 100% in line. So it's important to talk through those things. For example, let's say you're a couple same age and one of you wants to retire at age 60. And so you're feeling it very important to be saving more, maybe paying off debt in your late 50s. And then the other one says, you know what, I love my job, I want to work till age 70. Well, their goals may not be aligned with yours. So it's really important to not only document it, understand it for yourselves, but then share it. You know, we want to socialize this with those that are important to us and deal with this as well. So talking about balancing acts, one of the things that happens too, and this goes back to the fact that sometimes we're letting life control us rather than controlling our lives, is we all have to make trade-offs when we're doing things. And so we want to look at our current wants, wishes, our current needs. You know, needs are things like basic shelter, food, clothing. A want is something like, well, I'd really like to go out to eat this week. Maybe we can go out Friday night. Maybe a wish is, I'd like to go on a dream vacation at Disney World and take the whole family. And so there's current, but then there's also future. Since the currents always interface in day-to-day things that we deal with, a lot of times those may overwhelm our future needs, and it's easy to procrastinate. It's easy to push those off. The other thing that's, I think, really interesting is, what is a want and what is a wish? You know, I have a 14-year-old nephew, and I think he has a hard time distinguishing between a need and a want. He can differentiate a little bit between a wish and a want, but he doesn't really know the difference between a need and a want. And I think a lot of us are running through life and we don't really say, do I really need this or do I want it? You know, do I wish for this or do I want it? So it's important to really think critically about what we want, what we need, and what we need to do to get those things. And then don't ever forget about the future. You know, we all go through a life cycle. One nice thing about us all is we're fairly predictable. You know, if you look at the American culture and globally, you know, humans are humans, and we're all a little bit different. But you know, if you look at where you are in life, what you do, where you live, you probably can come up with a very similar life cycle of financial decisions that we're all going to be dealing with. You know, so in the beginning, you can see the sine wave there. It's actually positive. That's showing a positive net worth. When we start out, if we owe nothing and we start working, suddenly we're building wealth. But then what happens? You know, that's when we have our first job. And then maybe we get married, you know, and we start spending money there. We, you know, pay for the wedding, or maybe we go on a trip. And then maybe we buy a house. Suddenly we may start going into a negative net worth situation. Maybe we went to Trinity. We are carrying a little bit of college debt from leaving there. So you know, in early life, we actually start tending to go negative. So we actually tend to owe more than what we own. But over time, you start building that through work and making smart decisions. And you get to a point where maybe future goals are important. You know, you may have bought your first house, and now you're looking at your second home. You may have your first child, but now you're trying to save for a child. You know, pretty soon, though, things start getting the light like, hey, I'm not going to be working forever. I am immortal. Maybe I want to start saving a little bit of money so that I can spend it when I'm not working. You know, so we all go through similar life cycles, you know, and then at the end of life, you know, medical expenses start creeping in. That's something that we don't like to think about. So it's important to identify that we all go through these life cycles. And I hope that everybody has a healthy, happy life, and, you know, we get through these easily. But, you know, sometimes we don't always know that. So it's important to build a roadmap. You know, where are we going? What does life have for us, and what do we want from life? Because it's easy for us to prepare for the expected, but we also need to start planning what is the unexpected things that are going to occur. You know, if we don't know where we're going, how are we going to react when there's a fork in the road? So we need to think about that, and we can do that by clarifying our financial goals. And we also want to develop a strategy and prioritize those goals so that we can maybe move on through those. You know, so when we start looking at the expected and unexpected, I've found that, you know, it's not what you plan for that throws you off. It's what you don't plan for. I remember when I started, anybody that remembers, I graduated in 1998. And so back then, a lot of the younger folk won't remember this, but we had Y2K. All of our computers were programmed without, the ability to go from 19 to 20 for the year. And so it was a real big disaster. Everything had to get programmed. And everybody said, well, this might end. And, Morgan Stanley, for all of our clients, did a big event. And our CEO was up there talking. One of the first questions was, are you going to be prepared? And he said something that I've always held on to, and that was, what gets us isn't what we prepare for, it's what we don't prepare for. And sure enough, Y2K went fairly easy, not many hitches, but then 9/11 occurred, and we were completely caught off guard. Paige, do you have anything to add on that, or what are some of your experiences?
Oh yes, we've actually had quite a few unexpected medical events in our family, and from the time my first child was born through turning 11 years old and having 3 additional children, we essentially had no health problems whatsoever with the children, and life cycle went right along that curve as John was discussing. So we were able to plan. We had saved. We actually were pretty conservative with our saving. Started early and saved quite a bit, and it was really fortunate because within a very short period of time, within about a 1-year span, we had 3 different health crises with our children. With our oldest child being diagnosed as a type 1 diabetic. And the thing about that is we didn't have that on either side of the family. So it was completely unexpected, but having planned a little cushion for the unexpected, it was extremely helpful to us. And then our future plans incorporate both his condition and a couple of other things that we've had to face. So, starting early, being careful, being very conservative with your finances, and when you do plan, helps sometimes with the unexpected as well.
That's so right. Thanks for sharing that. It's a little personal note. It's interesting because we work with a lot of clients and in their financial planning and affairs and the retirement, and it's always that unexpected thing. It's when a layoff occurs that they weren't anticipating, or when a health issue comes up, and it's those things that you actually, in a weird way, you can actually prepare for them because you don't know what it is that's going to come, but it does happen. And so we can plan that something that we don't plan for will occur.
And it is always something.
Yeah,
right?
It just life happens.
Yes.
So, well, let's go back to the presentation. And let's start talking about this process. So, how do we get there? So we want to start talking about 3 key points. Our goals first. What do we want? Is it a new car? Is it to pay off student loan debt? What is it that we want in life from a financial standpoint? Then we want to start reviewing our resources, right? Because if we know where we are and we know where we want to go, we need to figure out what we have to get there, right? If we're trying to cross the river, do we have a bridge or do we have a rowboat? And then planning. That's the plan. I'm going to take the bridge. That's a lot easier. We might not have it, so I'm going to row really fast. So we need to figure those things out. So let's start with our goals. What is it that we want? A lot of you may have a concept of what you want from a goal standpoint and in finance, and you might not have actually thought about it until today, until this slide right now, and you're probably in the column there on the left. You're listing your goals, and you're saying, I want to pay off my student loan debt. I want to save for my child's college education. I want to retire with enough money to live comfortably. These are great goals, but I hate to tell you, you're going to not probably achieve these goals if you start with them and leave them on the left, okay? It's really important with any goal, whether it's a financial goal or other things, to make them a little more specific and constructive to where you can achieve those goals. It's very critical to do that. And so when you're building your goals, you want to refine them, okay? You want to get specific on it. So rather than say, pay off my student loan debt, I want to eliminate my student loan debt over the next 5 years by paying off $128 a month. Okay, if you make it into a consistent habit, it's going to be a lot easier. Okay, same with college savings, same with retirement. All 3 of these are interesting because as I've been at Morgan Stanley over the last 18 or so years, they've all inflated quite a bit. It's scary to hear, but the average millennial is graduating college with $100,000 of student loan debt right now. So that for the parents that are trying to save for college, it's a moving target. It's a really difficult thing to save for. And then when you start looking at retirement, people are living longer, and healthcare costs have been on the rise. So all of these things can be a little challenging. So it's important to be engaged and aware and say, hey, you know what, this is a big deal. So what do I need to do on a daily and monthly basis to make this happen? When you're doing this, you need to build your short-term and your long-term goals. And actually, I think we have a question. Is there a question there, Paige?
Yes, we do. Before we get too far down the road here, we have a question about the planning for the unexpected financial obligations. We have a question that asks for a recommendation regarding unexpected obligations. How much would you recommend for medical emergencies and layoff? Is there like a percentage, or is there something you would suggest?
That's a really great question, and it's hard to say, and it's actually one of those short-term goals. You know, what is my emergency fund? That's really what we're talking about. You know, you can ask 10 different people, and they'll have 10 different answers, so maybe I don't know. You know, a good starting point as a rule of thumb is 3 months of living expenses. Okay, so let's say you get laid off from your job. You need to be able to pay your bills and live for 3 months to try and find something else to get some income again. You know, that's usually a good rule of thumb, but you really need to think closer on yourself. Because let's say you are, you know, let's say you work in the oil fields, okay, and everything's doing really well. You know what? You probably don't have to worry as much as when you start seeing the price of oil going down and you start seeing those layoffs. Okay, so you need to look at that job security. Let's say you're a professor with tenure. You have a lot more job security than maybe somebody that just started out in their career that is in a probationary period. So if you're earlier on and you have less security in your job, you need to save a little bit more. But then you also have to look at yourself. If you're an individual, you may not have to be as prepared as if you're a family. Okay, and if you're a family, however, if there's 2 wages, now suddenly there's 2 people that can take the blow if one of you does lose your job. So there's not a hard, fast answer to that. But generally, I'd say start with 3 months of living expenses, including debt service. And then depending on your comfort level with security, then you might want to increase it to 6 months. Or if you know something's imminent in the horizon where you are in a company that may be downsizing, well, then you may want to try to get the 6 to 9 months. So it's not always a right answer there. What I will say, though, is a common financial planning error that people make is they save too much in a short-term emergency fund, right? So having the correct balance there and knowing when to start putting that into maybe a medium-term fund for some of your medium-term goals is important. Great question. You know, and that leads into the slide. So when we start looking into our short-term goals, you know, one of them is building that emergency fund. You know, it's different for everybody, but a good starting point is 3 months worth of wages. If you have a lot of job security, you can maybe do it with less. You also need to review, do you have other liquidity vehicles like lines of credit or a lot of equity in your home or some savings in retirement? So those are some things to look at. But you might be in the situation like me, my car's 10 years old. I need to get a new car pretty soon. I know it's on the horizon. But you also might be planning that Christmas vacation right now. You know, and what you want to do, though, is document your medium-term goals and your long-term goals with those short-term goals, because maybe that vacation, maybe I can spend $1,000, maybe I can spend $5,000 on that vacation. If that's going to prevent me from making a down payment on my house that I want to buy in the next 3 years, I need to take that into consideration.
Along these lines, we have another question, but I'm going to recast it a little bit. The person is asking about where to put emergency funds. Like, how would you make that money work hard for you? Do you recommend matching your investment vehicle, let's say, to the horizon or your goal horizon? Or what do you suggest with that? That's
a great question. You're actually thinking forward here, because we're starting to move into longer term modules on how to save and invest money. To Paige's point, you want to match the goals with the investment vehicle. So when we're looking at an emergency fund, you want something that you know will not go down in value. And basically any short-term goal, you need to have a heavy weighting on investments that don't lose money. So this would be cash, checking accounts, maybe what we call a money market, where there's no risk that it drops in value and you have immediate access to it at any time. When you start looking at a medium-term goal, well, maybe we can buy a 2 or 3 year CD that might pay us a little higher interest rate. A CD is an instrument you can buy from your bank. Doesn't pay you a whole lot, but it pays you more than a checking account. And maybe you can put a little bit of money in the stock market. And then when you look at your longer term goals, the odd thing there is the risk is not the principal. The risk is the inflation risk. So, if you're saving in your retirement plan at work or saving for retirement, your number one risk there, if you're younger, is what's the value of the money going to be? So you need to put in things that may have a lot of short-term principal risk, but has limited inflation risk. And that would be something like a stock or the stock market, where very risky in a short-term basis, but over a 10, 20-year period is one of the safer places to be. Thank you. So once we build our goals, we want to also prioritize them, right? Especially when we get into those wishes. We want to get our needs met. We want to figure out our wants. And then if we have enough money, we can plan out those wishes. But, those might start being competing goals. So we want to make sure that we're making sensible trade-offs. In the slide, it says, don't sacrifice your retirement for your children's education. This is something I see changing in the last 10, 15 years. But there was a mentality about 20 years ago when I was going to school that I don't care how much it costs. If my child gets into a school, I will pay for it. That's changing a little bit, but think of finances the same way as when you're flying in an airplane. When that flight attendant says, put on your oxygen mask first and then put on your child's, think the same way, because if you're not financially fit yourself, you need to be that role model. You need to be healthy to protect other people that you're trying to take care of, whether it's from college savings to other things. But your retirement assets and yourself is more important. So start with yourself and then build out. Okay, make yourself in a good, healthy place so you can protect others. And, and then it gets to questions like, do I decrease debt or do I invest? It's a tough choice, and there's not a hard, fast rule there. But I had a lady recently who works for a company, and they have a 50 cents on the first 6% match on their 401k contributions. She's getting closer to retirement, and she said, well, I'd really like to pay off my mortgage, which happens to be a historical low interest rate of about 3%. And so she actually decided to stop putting money in her 401k plan at work, where she gets this match, which is essentially free money. It's she gets a 50-cent return on every dollar she puts in for that first 6% deferral in order to pay off a loan that was at a low interest rate. And so I told her, well, at least do 6 first. So you got to make sensible trade-offs. Is there another question?
Yes, there is. We have a question this is a perfect segue into the question, because this person is asking about trade-offs. The family has some cash on hand they've saved, and they also have some debt. And they are wondering if they should halt savings in order to use it quickly to have it for a 3-month emergency fund. Or should they do some debt buy down? So they're wondering about the trade-off between continuing to save or to pay off debt. And you just talked a little bit about that.
And trade-offs is an interesting thing. One thing I'll say is there's never a completely right or completely wrong answer, and it's never a binary decision. So it's not something that's black and white, because there's some unpredictable aspects of it. So generally, there's not a pay off debt or save. It's usually blending the two. Okay. What I would do is I would start by looking at the debt and looking at the cost to carry. That's what we call the interest rate. So if you have debt, like let's say you have a car loan through Honda, and Honda Motor Corp subsidize your loan at a 0% interest rate, that debt is not expensive to carry. So it wouldn't be an urgent thing for me to pay off. But let's say I got behind, or I had an unexpected medical need which was way beyond my planning, or I just wound up with some credit card debt and it was at 15, 16, 20%. Well, those types of vehicles, I would probably prioritize it paying down a little faster. And then when you're splitting it, what you also might want to do, let's say it is credit card debt we're trying to deal with. You probably have more than one if that's the case. I would list them in order of amount, and maybe anything above 10%, I would list them on one side of the page, and I say I'm going to pay these off, but I'm going to target the smallest total balance first. That's actually a Dave Ramsey technique, and it's probably not the right textbook answer, because you know the PhD in finance is probably saying pay off the highest interest rate first. But there's some mental wellness.
I was going to say there's some psychological factors of feeling you've conquered some of your debt. So
yeah,
right?
And so back to answer the question, you know, clearly both items are on your mind. I think you need to figure out which one's more salient or troublesome to you,
right,
and start tackling that one first, but don't forego the other one. So if it's $100 of money that we're deciding how to spend, maybe send $75 of it to the debt reduction and $25 to the savings. And that being said, it's always important to do a little bit, even if it's not meaningful. Like, let's say you have this extra $100, do something, maybe save $5 or $10 a month, just for the habit of the principle of doing it. Let's actually flip to page 8 in the workbook. And this starts helping you analyze and prioritize those goals, so that when we do look at them, we can say, okay, what is the trade-off, and where should I spend more money? So the top section of the workbook, you might want to expand this maybe onto a little note page, but it starts with that general goals that we talked about, right? It's the pay off my student loan debt. And what I want you to do here is write 2 or 3 short-term goals, medium-term goals, and long-term goals on the left side, the bottom of the chart. And if you need more space, you know, do it maybe on a worksheet somewhere. And then take each of those goals and prioritize them. You know, rank them 1 through 3. You know, and then you do 1 through 3 on the short term, 1 through 3 on the medium term, 1 through 3 on the long term, and then go and try and refine those goals a little bit. So make 1 revision, and then you might want to do the second revision today. But I find sometimes it's very healthy for me to make that first revision, and then to think about it for a couple days and come back and revisit it. You know, so you might want to go through the exercise of revising them both at the same time, but then come back and reflect on that, because, you know, the mental state you're in right now might be a little different than what it is in a few days. So it's good to review these. And by the way, if you're doing this, keep it in a file. Keep it in a file, and keep your old work over time. You know, I don't know how many of y'all go back to your old papers or something you wrote at Trinity. I always look at it and I'm like, wow, look how smart I used to be. What happened? You know, but you might go back, and by memorializing what you're doing over time, it's going to help you achieve your goals, but it's also going to help you identify what is important and maybe help you in that prioritization. So I keep those in a file, and try to review them on a regular basis. So once we have our goals established, now it's how do we achieve them? Okay. You know, before we go on, do we have any other questions that are time sensitive?
I think we can wait for this one until we get a little bit deeper into the discussion.
Okay. Looks like we have a question might be good for the cash flow discussion.
Yes.
So let's start talking about what we have. Okay. And we basically have 2 things, and this is our starting point. Okay. And think about like you're taking a road trip. You know, we're in San Antonio today. Maybe some of y'all are in LA, etc. But if I'm in San Antonio and I want to go up to LA, I have a couple of things. I have where I am today, and I have my car. And then I have the time I'm going to need to spend to get there, and what I'm going to need to spend in gas, etc. Okay. And so when you're looking at the net worth statement when it relates to your finances, that's where you are today. Okay. And for me, it's San Antonio. And retirement might be where I'm trying to get to. That's LA. Okay. Well, I don't want to get in the car and start going east on I-10 to Florida if my goal is LA, right? So it's important to understand where you are and where you're going. But then you want to understand the cash flow summary, okay? And so the statement of net worth is what you own minus what you owe, giving you a net total of your total assets minus liabilities, and it's a dollar figure. It may be a positive, maybe a negative. But then on a monthly basis, this is your cash flow. So you young folks out there, you probably have very little net worth. You don't own a lot, you know. You may not have a big financial mark on this earth if you died today, but you have a lot of human capital. Your ability to work and contribute to society and earn money is your big asset. That's your cash flow, okay? And what your cash flow is your earnings and all income that's coming in versus your expenditures and what you spend, okay? And so that shows your total cash flow. And so let's talk a little bit about net worth, and we'll move on to cash flow, and we'll hit that tax question. So determine what you own versus what you owe. Okay, so why we want to do this is to create that clear starting point, but it also gives us an estimate of what we have available, okay, and how we should deploy those available resources. We can do this by preparing a snapshot of ourselves in time. You know, I don't know the best day to do it. It's good that we're doing this in December, because maybe December 31st is the best time of year to do it. What I will say is try to be consistent. Some people like to do this when they're filing their income taxes. Some people file them early, some people file them on April 15th, and some people file an extension. So whatever you do, do what works for you in your calendar, and try and be consistent on an annual basis. And what it is, you're going to want to document everything that you own. Okay, so your assets are what you own. If you own a house is an asset. If you own a car is an asset. If you have a 401k or another form of a retirement plan at work, the dollars in there is an asset. And then let's look at what we owe. So if we own a house, we may have a mortgage. A mortgage is a liability. Okay. If you have a credit card, the balance on the credit card is a liability. Some people say, well, I don't carry a credit card balance. Well, that's true, but if you accrue it, you have a short-term liability that you're going to pay off on a monthly basis. Okay, so it's what you own versus what you owe, and then we can create the statement of net worth. The net worth is the difference between the two. So when we start looking at, want to add up all your assets, and you want to subtract out all your liabilities. So again, we have your cash accounts, checking, money markets, retirement accounts, your retirement plans at work, real estate, the value of your home, personal property. Usually these items, unless it is maybe a collector's item, you know, you want to look at a garage sale price. So I just generically put $5,000 of personal net worth when I look at just personal belongings. I do put my car there, which is probably worth $5,000 today since it's 10 years old. And then you take the liabilities and you add them up, and then you subtract the assets minus the liabilities. I like the house because this really crystallizes the concept of net worth. So if you own a home that's $200,000 and you owe the bank $100,000 in your mortgage, what's your net worth on the house? What's your equity page?
$100,000.
Exactly. So if you sell the house, you're going to collect $200,000. Let's assume there are closing costs, right. And then you pay off the mortgage. You owe them $100,000. So now you're left with $100,000 net from selling it. The nice thing about a home from an asset standpoint is a home tends to appreciate over time. So, and in the meanwhile, you're paying off that mortgage in a monthly cash flow, monthly payment, and that's decreasing your debt on there. So over time, the gap of your equity or your net worth in the home increases. Now we can apply that to everything though, whether it's a credit card that we're trying to set additional payments to versus expenditures on, etc. Okay, saving and building a cash account or retirement account does the same effect. So once we review the net worth, you want to determine what you make and what you spend. Okay, why we want to do this is you want to understand your spending habits. You want to identify where you can cut back on spending, and then estimate how much you have available. Okay, so by analyzing how much money you make and how you spend it over a given period of time, you can then figure out your income and expenses. By the way, that's a typo. It's a review your cash flow on the top is what it should be saying. So things you'll need to do is figure out what your income is and what your expenses are. And actually, real quick before we keep going in there, let's flip to page 10 of your workbook. And this is back on the net worth topic. If you go to page 10, you'll see a nice little worksheet here. And you might want to take it and turn it into electronic copy. But I like this because it's a good starting place, documenting assets that a lot of us may already have. And there's room for other on here too. And then documenting liabilities that many of us already have. And so this will give you a good starting framework because, you know, it's easy to forget about this or that, or hey, I forgot about this thing. Now, one thing to remember is on the liability, so you may have a cell phone bill. Somebody mentioned those may not be a liability unless it's a lump sum that you owe. Okay, so like a credit card with a balance is a liability, but my water bill is just a monthly cash flow expense. So document what you owe here. So if you do pay off your credit cards monthly, I'd probably put a 0 for those. But if you're carrying a balance for some reason, I would put the balance on there. Okay, and but this is a nice little worksheet that'll help you go through that. So now let's start talking about the cash flow. Okay, so we've identified what we own and what our net worth is based on the total assets and things we own minus the things that we owe. But now let's talk about cash flow. So the first thing you need to figure out is what's coming in, okay? This is going to be your salary, your wages, any side work you're doing where you're getting compensated on a regular basis. It's also going to include things like investment income. So let's say you do have a savings account, you're earning some interest on it, that's going to be cash coming into you, okay? Maybe it's some stock accounts where you're getting paid dividends. Maybe you own a rental property where you're getting paid some rent on that. Those are all the monies coming in. But then you want to look at your cash outflow. So these are going to be your fixed expenses. So it's going to be your mortgage, your insurance, your car loans. You know, one thing that's interesting here is, you know, I always like to think about this on an annual basis, okay? But then I like to fine tune it down to a monthly basis through the budgeting worksheet. So I would, whatever you do here when you're doing your cash flow, you can do it monthly or annually, but try to annualize monthly expenses if you're doing it annually, and try and turn an annual expense into a monthly expense. I bring that up because, like the insurance, some of us pay our insurance one time a year, and some of us pay it throughout the year in monthly installments. But whatever you do, make sure it's the same, you know, period of time when you're doing this, and figure out those fixed expenses. A fixed expense is an expense that doesn't change. So this is going to be your mortgage. This is going to be your car payment. Insurance is usually a fixed expense, but although premiums change from time to time, your variable expenses are the ones that change more monthly. So it may be your utility bill, right? And it's important to identify that annually, because my utility bills in San Antonio are a lot lower in the winter and spring months than they are in the summer months, right? So it's important to identify that, because if I lock down my monthly cash flow and then my utility bill goes up $100, it might throw me off. And then the income taxes. You know, you can see these on your W-2s or your 1099s at the end of the year from your employers, but you also can go look at your paycheck and see your year-to-date figures and your monthly figures there. But your cash flow is going to be the total income that comes in minus the total expenses. So if you're underwater and you are actually spending more, maybe you lost your job and so your income shrank, but your expenses stay the same, you have a negative cash flow. That's an area we don't want to be in, right? What we want to be in is that total income being more higher than the total expenses. That gives us positive cash flow. Now, this might change in time though, because when we're retired, you know, while we're working, if we're building for retirement, we'll probably have positive cash flow because we're building and saving that extra earnings we're making to budget for spending in the future. But when we get to retirement, we stop working, we're going to start spending that savings. And so it's normal to be on both sides, positive and negative. And it's not uncommon for us to maybe live 3 months of the year in negative cash flow and 9 months of the year in positive cash flow. We also have a worksheet for this. This is page 12 of the workbooks. And again, you know, I like to do it with an annual number. And then I take that annual number and I move it to a monthly figure. But you've got to be a little careful there, because like a tax bill, you know, you have to see when that is. But this will start by taking all your inflows and all your outflows. Let's talk about those taxes, though. Somebody had a question on taxes and how you deal with them. They're a burden. Nobody likes to pay them.
Right. Well, this particular person is saying, I have no debt right now, and the taxes are really becoming a burden. And the person is asking, would it be wise to go into debt to buy a car to improve the tax position?
Interesting. So that's a very complicated question. So when you look at the taxes, okay, so we're going to pay taxes as we earn money. Okay, so when we're looking at our cash inflow, we're going to have that coming in on our earnings. And then if you're a W-2 employee, which means that you're employed, and you're not a contract worker, they're going to have a paycheck where they're going to withhold your federal income taxes. And so as an employee, a W-2 employee, they're going to be taking federal withholdings for you, because you actually owe taxes when you earn them, okay? So if you're self-employed and you get what we call 1099 income, you actually, the first year you become self-employed, you usually get caught because the IRS comes and says, hey, you were supposed to pay taxes quarterly. Why didn't you do that? So be aware that you should be filing quarterly if you're self-employed. Now, when we start going into this question, though, it starts getting into taxes related to purchasing of an automobile. Mm-hmm. Most of the time, an automobile expense is not a deductible expense. So the goal is to say, hey, I don't have any debt. I have this money, and it's becoming a burden from a tax standpoint. You know, a house, if you don't own a house, Now, a house does have some tax advantages because if I own a house as my primary home, the mortgage, and what I would do is I would actually carry a mortgage in today's environment because we have some of the lowest interest rates in history. That mortgage interest is deductible. Okay. The other thing is that your real estate taxes are deductible. So, you know, the taxes come in different forms, but when you do your federal income tax filing, if you own a home, your interest expense, so the interest you pay throughout the year, and I'm just going to, real simple example, let's say my average mortgage balance is $100,000 and my payments $700 something a month, and that's just the principal and interest. Well, a portion of that payment's going to the interest, and if my interest rate's 4% on $100,000, about $4,000 a year. So now I can collect $4,000. I think it comes on your 1098 if you have a mortgage. You can put that into your income tax and it's now deductible. So now you reduced your income by $4,000. If you're in the 25% tax bracket, you just saved $1,000 of taxes by spending it on interest, which
Wow.
you know is better than nothing. But that's one way to do it.
But the car won't help.
The car will not help unless, let's say I'm an Uber driver and 90% of my vehicle usage is for that. I can probably deduct the vehicle. Okay, so it goes back to what's deductible. The other thing you can do is you can start maybe using an IRA, individual retirement account, or an employer-sponsored retirement account. And this again goes into the budgeting, right? Because how much am I saving on the cash flow? You know, where's that money going? Well, if I work for an employer that has a 401k or 403b, a retirement plan, I may be able to defer a percentage of my paycheck.
Yes.
And if I put it in there, I can choose to put it in on a pre-tax basis, which means it lowers my taxable earnings from a government perspective. I pay that in the future, but on my paycheck, I may have avoided paying the income taxes. The IRS limit on a 401k or a 403b, like a university would have, is $18,000 a year if you're under age 50. You can do a little bit more if you're over age 50, but if you can afford it, you could put that much money into those plans in some cases and reduce your taxable earnings by that much.
Same thing with your flexible medical spending accounts and other types of things like that, and you're not necessarily having to lock yourself into owning a home that you may or may not really want to buy.
Exactly right. And you start getting into the individual side. Let's say your employer doesn't offer a retirement plan, or I don't know, the things of that nature. You're an independent contractor, etc. Now suddenly you may need to look for your own vehicles, but there are things like IRAs, etc. that the federal government gives you an incentive to put money in here through taxes, and it saves you money to do so.
Back on the home ownership you've been mentioning, we have another question. And the person says, should I prioritize home ownership over renting because of rising rent prices?
You know, that's a really...
It depends.
I'm very emotional about that subject because I've seen over the last 10 or years that it's been one of the most affordable times to buy housing because we have such low interest rates. Yet home ownership in America has been shrinking. And what scares me about that is if I buy a home, I have set that price forever of what I paid. Okay, I've spent the $150,000 or $200,000. I may be doing it over time, but I've spent the total purchase price. And now if the home's inflating and it's getting appreciating, it's becoming more and more expensive over time, it's hard to buy it in the future, right? But by buying it, I've locked it in, and then also getting some tax benefits. And yet we're seeing home ownership shrink, and we're seeing inflating rent rates. Yes. So as a renter, you're not locking in those rates forever unless you live in a rate-controlled environment. So there are some places that does happen. But I do think home ownership is important. What I would say, though, before you make that commitment is, where do you live? Have you been in a housing market that's been inflating or decreasing? If you live in San Antonio or Austin, you know that you're in an inflating real estate market. Right. If you were in Detroit, it's starting to probably come back around, but it was declining for an extended period. Nationally, houses are coming back around, so I'd say at a national level, we are seeing inflating home rates. And I do think that we're going to start seeing some rising interest rates. I can't be sure of that, but I think that historical low interest rate environment we've seen may have kind of, it's not going to go up overnight. We're going to enjoy some time period of lower rates than history, but I don't think we're going to see lower rates than we see today. It may be short term, maybe a month, we'll see it, but I doubt we'll see lower rates. So I think it is a good time to lock a long-term interest rate, because of the historical low rates, and two, to lock the house price. Now, if you know that you're not going to live there in 2 years, don't buy the house. The house is a long-term asset, and it's expensive to unwind it. So for it to work well, you have to own it for at least 5 years to really try to break even. For those of you that have purchased a home, and by the way, there's a module on home buying that we may do in the future. There's a 80% loan to value is kind of a generic term, 80 loan to V or LTV. The reason for that is the bank who's lending you the money, or the regulators, et cetera, have decided that 20% is about the cost to get out of a house. So if you buy a house and then you immediately default on it, the bank has to repossess it and sell it, they're going to pay about 20% of the asset. So, and houses have been appreciated at 3 to 4% or long term in America. So think about that. At 3% or 4%, that's about a 5-year break even if the house is appreciating. So if you're buying a house, know that you're going to own it for at least 5 years. And that's kind of how I'd make that decision. But I do think it's a great time to buy a home, to lock in the price of the home, because even if it's your permanent home, you're putting chips into the table to hold as a placeholder, right? So if I buy a $100,000 home and the real estate market's appreciating at 4% a year, when I go to sell it in 10 years, it's appreciated in value, and now I have more money to put into my new home. Great question.
Of course, there are a lot of expenses associated with home ownership, but I strongly suspect that anyone who's renting a property to you is passing any, maintenance expenses and rising prices.
Exactly. And that's,
assets onto
prepare for the unexpected.
Right.
As a new homeowner, there's always a lot more expenses than you expect. And they become your responsibility. So when you're doing your calculations of what you can afford, budget in a couple $100s of maintenance. And it may not be used every month, but when you need a new roof or a tree dies, or you have to
that water heater,
the water heater, things happen. And so try to budget about an extra $200 a month for maintenance as a homeowner.
Yeah. Okay. So in talking about your spreadsheet here, not your spreadsheet, your worksheet here, we have a question saying, should I put savings as an expense or outflow on my cash flow summary? To get in a habit of saving and reducing the extra amount I think I should have available to spend on fun things.
Yes and no. So on the cash flow statement, I probably wouldn't put it in on the first draft. Okay, because this, again, we were talking about maybe trying to do this on an annual basis. Okay, when we get into our budgeting is when I would probably budget in the savings. The reason being is my savings is something that I can adjust if need be. Okay, and so what I would probably do is I'd start with the cash flow where I don't include savings or debt reduction. Okay, I only put required debt reduction, which would be the minimum credit card payment or the minimum mortgage payment. And then once we get to our monthly budget, which will build from the cash flow statement, that's where I would budget in. Okay, I have an extra $500 a month. 300 of it's going to go for a savings. 100 is going to go for additional debt reduction against my student loan, and the other 100 we are going to reward ourselves if we do those things, and we're going to spend it going out on Saturday night. Yeah, there you go.
Right.
Any other questions on that?
Let me see. Oh, yes.
You got a lot of questions.
We do. It's great. Do you want them now, or do you want to?
Well, are there any?
A couple of retirement.
On retirement? Let's do this. Let's go on goals, and then we'll hit some retirement discussions. Okay.
That sounds great.
So plan to achieve our goals. So we want to track the spending, and this is going to tail into that last question that we had. So we want to record every dollar we spend for a week. Okay, this is a very exciting exercise because you look back, it's like, what did I do? Okay, and for those of you who live in San Antonio and are use saws for your water system, what they do, we have to pay for sewer. Okay, which means what does it cost them to run the infrastructure for wastewater, right? They say, well, people probably don't water their lawns in the wintertime, so we're going to take the average winter usage and we're going to say that's your sewer usage. And so based on that, we're going to charge you on an annual basis, monthly. So I'm kind of a miser there. So like, I know they're tracking me, so I try to use as little water as possible. So I have, an artificially low thing, because I know they're going to take it and they're going to charge me throughout the year. And so when we do this exercise, don't be me as it relates to SAWS, San Antonio Water System. Be honest with yourself, okay? And so as a good exercise, see where you're spending your money. You'd be surprised. A lot of us don't know where that money goes. So save all your receipts for a week. Dinner, shopping, drugstore. Write down what expenses you had without a receipt. Toll tags. Man, people spend a lot on your toll tag and you don't realize it just kind of comes out, right? It makes it so easy to spend. Are you going to the vending machine and buying that $1, Dasani water or whatever? List out all your bills, your mortgage, your car payment, etc. Put those into a weekly dollar and be honest with yourself. That's kind of what I meant about SAWS. Yes. It's so easy to say, well, I normally go to Starbucks, but I'm not going to go this week, so I'm tracking myself. Okay, so be honest with yourself. You don't need to share this with other people except those related personal financial matters like we discussed earlier in the presentation. But be honest with yourself and be aware of those thieves, right? Do you have a Keurig machine? Because, I drink about 3 cups of coffee, and I wanted to get one, then I realized, what? If I drink 1 cup of coffee, it makes sense, but I can brew a pot of 3 cups, and it's a lot less expensive. So identify the thieves that are in this. You might be surprised where you're spending the money. And if you look at page 14 of the workbook, you might be able to do this easier on your phone. There's some apps that you can do too. But 14 of your workbook kind of shows you that. And so it gives you a little calendar, and you can spend everything you need. Some of us might need to add some lines, I don't know who goes out shopping a lot, but try to add up everything for a week. And again, try and be honest, and then take those monthly things that you spend it on and try to put them into a weekly term, and that gives you how much you spend about a week. But you start looking at this, and you can say, hey, I can maybe save some money here or there. Should I be taking my lunch or should I be going out to lunch? When you start adding it up, you'd be surprised. I have a gentleman that helps me out, does a little bit of work around my house, my yard, etc. He loves smoking these little cigars, and they kind of smell good, so I like it when he's smoking them. But I was like, do you know how much those cost? And we started adding it up, and he almost collapsed when he realized he was spending about $2,000 a year smoking cigars. Wow. So it's important to figure out where this money's going, because sometimes it flows out in little bits and you don't realize it. And so then we can start identifying what are those fixed expenses and those variable expenses. What's the mortgage, what's the student loan, what's the utilities. Identify that utilities, entertainment, gas may change throughout the year. So when you do the weekly study, and let's say you're a school teacher and you are on break, you might not be driving as much as when you're actually working and going into school. So be aware of those little things that might change a little bit on a month-to-month basis. And then analyze it. That's what we were talking about. What items can you cut back on? What can you do without? What is, like my nephew, what's a wish and what's a want? Okay, it's important to figure that out. And what can you postpone any discretionary purchases? That discretionary purchase I love to talk about, because it goes back to one of those questions on retirement savings. If I can postpone some of my discretionary purchases, I have time to build up more cash flow that can be spent elsewhere. Marketing and the financial industry has made it very easy to just buy at whim. I don't know if this is true, but it's a great story, and I've heard it a couple times, and it came from a reliable source, so I think it is true. But there was a study of Harvard graduates that was done, and it was a long-term study. It was about a 4-year study, and the goal was to identify what is the key determinant of a financially well and successful person. And they looked at their families, their income levels of the families. They looked at the majors, what they studied, the GPAs, things of that nature, what careers they went into. And it was funny, the number one determinant wasn't really those things. The number one determinant of the financial wellness of the person over time was the ability to delay immediate gratification. Exactly. And so can I actually save the $500 to buy the new TV and pay cash, or should I throw it on my credit card? Mm-hmm. Because it's easy to buy 5 months, 10 months worth of things using credit. So be aware of that. And then once you start doing this, you might say, hey, I need to reprioritize my goals. Like let's talk about that retirement question, because that's something that, it's near and dear to my heart, because I spend most of my time working with people on retirement. And I find that they'll let a short-term need or goal or wish maybe prioritize over retirement. What was the question on retirement?
Okay, well, how do you feel about Roth IRAs? Mm-hmm. If you are 56 years old, would you contribute to a Roth IRA? And would you contribute at the maximum allowable amount?
Great question. And again, it goes back, there's not a right or wrong. Okay, so I like Roth IRAs. And was this Roth IRA or Roth 401k?
This is Roth IRA.
This is Roth IRA. And so what that means is individual retirement account. It's not through your workforce. I distinguish that because there's also a Roth 401k.
This person has just started a small tech business.
Okay. And so Roth IRA, when you're looking at taxes, okay, there's a saying that death and taxes. Okay, you're never going to get away from death, and you're never going away from taxes. As you die, you're stable low income taxes. Okay, so you can't avoid them. What Roth means is that I'm paying the tax today for tax-free withdrawals in the future, versus traditional, which means I get a tax deduction today, but I have to pay taxes in the future. Okay, let's assume all things are equal. Okay, and we're just looking at Roth versus pre-tax. If you put $1,000 in the Roth, that's probably the same as putting maybe $1,200 or $1,250 in a pre-tax, because by putting the money in the pre-tax, you're saving yourself the money in the taxes. So on a dollar basis, for every dollar I put in pre-tax, if I'm in the 25% tax bracket, I avoid paying 25 cents in taxes. So if I put $1 in there, it only costs me 75 cents on spendable money, okay, because of the tax benefit. So $1,000 in Roth and $1,000 in pre-tax, the Roth is more money saved, okay? So if you're just looking at, if you're in the same income tax bracket today as when you're retired, it's kind of a wash, okay? Because what's going to happen is the pre-tax pool is going to grow faster into a larger amount because there's more money in there, because you're also getting the benefit of the IRS's dollars. However, when you pull it out, you start paying taxes. So if you're in the same tax rate today as you are in the future, it almost comes out as a wash, okay? Because in the future, the pre-tax pool, you'll have more money. So you have to ask yourself, am I in a lower bracket today than I will be in the future, okay? Because if you're in a lower bracket today, you might want to pay the tax today when you're in a low bracket, because if you start a tech company and you're going to be in a very high income bracket your whole life, because it's uberly successful, which all Trinity students will be, you might be in a higher bracket retired, okay? So in that scenario, the Roth may make more sense. So I see it like when it goes to the workplace and you choose between Roth 401k or traditional. If you're a younger person and you have you just bought a home, you have 2 children, you're probably in a very low tax bracket. So it might make sense to do a Roth contribution. Now, let's say you are in your mid-50s and you're fairly successful and you're earning a decent amount of money. You might be in a high bracket, and most people retire in a lower bracket. Okay, so in that case, you might say, hey, actually, I want to get the tax deductions today so I can pay the tax in the future when in a lower bracket. Now, it gets tricky though, because this is an IRA. So depending on your taxes and how much you earn, you may or may not be able to make a deductible IRA contribution if you're also covered by an employer-sponsored plan, okay? So if you're covered by an employer-sponsored plan, then you need to be aware of this. Now, as an individual, if you don't have a employer-sponsored plan, the question is, do you feel you're in a higher bracket today or in the future, okay? And that's when I would decide to make a deductible traditional IRA versus a Roth, after-tax Roth IRA. Now, let's say I'm employed though, and my employer has a plan, and I'm making the same decision. If I make over a certain earnings threshold, then you'll figure this out when you do your taxes. And by the way, you can make an IRA contribution up until your tax filing deadline of April 15th. Okay, so when you do your taxes, you can see if you qualify to make a deductible IRA contribution or a Roth contribution. Okay, and then you can do the same discussion of, hey, I've already saved through employer, but should I also make it here? A lot of times you may be precluded from making a deductible IRA contribution, but you still may be able to make a Roth in some cases. It again goes back to the individual. But when it comes down to it, it's usually a decision of, am I in a lower bracket today or the future? You want to pay the tax when you're in the lower bracket. A lot of times the Roth is a good complement to a traditional 401k contribution, but it goes back to, do you need deductions today or not? And that's how I make that decision. And again, you know what? There's not a hard, fast answer, and usually it's an average. Personally, I save in my 401k, I do a combination of pre-tax and Roth inside my 401k because, you know, when I get to retirement, there may be times when I want to pull out the tax-free Roth, and there may be times when I want to pull out the taxable, traditional.
All right, we have another question along the same lines. Are you ready for this one too? Okay. If I have multiple accounts from prior employers, Roth IRA, government thrift savings plan, etc., is it better to consolidate them into one account to keep them where they are, or to keep them where they are? Example would be a Vanguard account, TSP account.
I'm a firm believer that most people should consolidate them, and I think you should have one of two accounts. It should either be consolidated with your current employer in their retirement plan. There's rare instances when I would split them and leave it in an old plan. There are some instances, and then I would also just from the maintenance. I've seen so many people actually lose those assets because they're 3 employers old, and then maybe an address change doesn't take place, or they forget to update beneficiaries. So trying to keep those consolidated is important. And we're going to move on a little bit. We're almost at the end of the presentation, so we can close down and open the questions. But we talked about creating that budget. So once we get the cash flow, there's that excess. Figure out where you're going to spend it, whether it's saving and doing the Roth contribution, traditional contribution, budget reductions. The question on consolidating, that's more of a statement of net worth and where those assets are held. And we want to manage that cash flow. What can you do? Can we eat out less often? Can we not buy on impulse? Buying generic versus the premium brand, does that make a difference? The last one on this slide says, don't allow yourself to be house poor, okay? I see a lot of people go out and buy their first home, and what happens is the real estate agent says, hey, go get pre-qualified. And one, they want you to get pre-qualified because they don't want to go through a lot of work and you not be able to buy it, okay? So they have a selfish interest here. But secondly, they want to know how much you can afford, right? Should I be showing them $250,000 houses or $150,000 houses? Just because you can afford a $250,000 house, don't let the bank decide that that's how much you pay. What are your thoughts on that? I know you have a nice example with car payments.
Oh, yes. Actually, when I'm teaching, I'm a finance professor, so not just the dean, but I also am very interested in all the things he's talking about here. But I use the example of buying a car, and a lot of times when you walk onto a car lot, the salesperson will come up and ask you, how much monthly payment can you afford? And that really isn't the question that you should be wanting to answer. Instead, you need to decide how much car you can afford in total, driving it off the lot, as opposed to the payment that you can make. Because what will end up happening is the terms of the loan can be manipulated in such a way you can work an example to show that a $30,000 car is somehow more affordable than a $20,000 car. We know that that is not possible. So if someone is trying to sell you on the idea that a $30,000 car is more affordable than a $20,000 car, it means that the terms have been manipulated and they simply are having such a long payout that they can make your monthly payment the same or even lower for a more expensive vehicle. So you have to be very careful about how you're spending that money, and the questions are answered.
I like to call that monthly magic in the payments. It's amazing what they can do with it. And it's important to know, just from a car buying scenario, I had a fellow Trinity student that graduated with me, and I remember he got a kind of a bad deal on a car loan, and I kind of felt bad for him. So when just a tip when you're buying a car, if you're trading in a vehicle, go into a CarMax or somebody that will give you a price to sell it. Okay, yes. Know that price to sell it. You don't have to sell it to them. Okay, so you know what your trade-in's worth, so that when you're going in and they're offering your price, you know if it's a high or low. go to your bank and get pre-qualified for financing. So, maybe your credit union gives you 1.9, so now you know the cost of that. And so then when you go into the finance office and they're telling you, well, we can give you an extra $1,000 for your trade-in, that may make sense. And there's a little more complicated things with taxes. I don't want to get into it now, but now you have a reference point. So when you're negotiating, you're in charge, okay? And now, yes, you need to know that the monthly payments are affordable, but don't let them sell you an extra $20,000 a vehicle because you can afford it monthly.
Because you think you can, right?
Yeah, because you think you can. Right. There you go. Well, we want to thank everybody for joining us. We have a lot of questions. I thought that was good. I hope we answered those. But we're here, and the most important thing, though, is we hope that we've built a little bit of a package that you can take with you. And this is an exercise I encourage you to do annually. Go through these, and again, try and save them in the same files so that you can reference your old work over time. With that, thank you very much, and Paige, we'll see you soon.
All right. Thank you again for attending this live webinar. Our next webinar is tentatively planned for February. That will be President Anderson discussing his thoughts on the university during his second year of presidency. Thank you very much.